Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 27th, 2018. This video is part two of two videos that I've done today on the semiconductor sector. Part one focused only on the long-term chart, going all the way back into the 90s, the mid to late 90s, on the Philex SOX Semiconductor Index. You can do that because that index has been around that long. We don't have any ETFs that go back, at least not sector ETFs back then. That was just the early days of ETFs. Back, we might have had SPY or something going back there. But either way, you can only go back so many years on most ETFs because, so what I'll do here is start with a weekly chart, and I will focus and cover the three main semi ETFs. Those are SOXX. Now, this isn't the actual index. Before I was showing you the index, which on at least on this charting program, everyone's different, is SOX.X. That's the actual index itself. Now, you can't trade an index. You can't buy the S&P 500 or the NASDAQ 100 or any index or sector for that matter. You have to have a trading proxy that tracks a sector. So the SPY is simply an ETF that tracks the S&P 500 index. And in this case, so that's what we're going to look at. Now, most ETFs will do a bang-up job. The charts are going to mirror each other. I just wanted to tell you the difference. If you were confused from watching that video and seeing all different levels, price levels, and that's why you're not seeing that. So going by that as well, if you're tracking the SOX, now the Philly SOX index is the longest, by far the oldest, and it was the original semiconductor index. This is my preferred trading proxy, SOXX, the ETF that tracks that index, for a couple reasons. Number one, that index has been around a long time. I can look at the long-term chart as I did in part one, but it also this is the same sector in which, if you like the leverage ETFs, which I will at times, there's pros and cons to that. Maybe I'll expand on that in this video if there's time. I did on the site today in the trading room the pros and cons of using ETFs. And let me just say this: if you don't have time, check out on the FAQ page on the top menu right side of the chart. Go to once you click on the FAQ page at the very top, you can hit subcategories. Go to the ETF related questions, and then there's a question, something to the effect of what are the effects of holding a leveraged ETF for a long period of time. And again, there's good and bad. In fact, you can actually do better. The leverage, for the most part, there's a very negative opinion on holding these things anything more than a day trade, but I use them. I'll tell you where I use them in IRAs where you can't short. They're a great proxy there, and you just have to be careful to get in at the right time, which is particularly when they're trending in the direction of your trade, and you want to avoid it during sideways choppy consolidation periods. Again, check out the FAQ page and it expands on that more. All right, so that's why I like SOXX, because if I'm charting that, and the other thing, because these three-time leverage ETFs over time do have decay, meaning this chart over longer periods of time will differ from the chart of the underlying index, unlike SOXX. If you look at SOXX, this will mirror almost perfectly the SOX index. Therefore, even if I'm trading SOXS, which is the three-time short semi, or SOXL, the three-time long, I'll always confirm my entries and exits, meaning my price targets, buy levels, with this chart, especially for longer term trades. So I wanted to just get that out there so there's not any confusion. And I'll cover XSD and SMH. I had a request. I know a lot of people on the site and other traders trade SMH, which is another one. They're all very similar. And before I roll into all the charts, let's just talk about the similarities and differences. These are the holdings. You can just do any ETF, and I recommend this to everybody. If you're trading an ETF, especially actively, there's one or two sectors you like, go to the company's website, do a Google search on SOXX holdings. That's it. And then stay away from the first few hits, Morningstar and all those others. I like to get information straight from the horse's mouth. So I go to the fund's website, and this is from iShares.com. So this is that actual ETF reporting their holdings. So this will be the most accurate information you're going to get. And you can just get an idea on SOXX, for example. And the reason I'm telling you I do this is I can see that that just a handful of stocks, very similar to QQQ, are by far the top weighted components. In fact, if you go down just eyeballing it about right here to ADI, so about the first not even 10 or so holdings make up about half of the returns of that index. That's got to be about 50% or so right there. So therefore, where these 10 stocks go, that ETF is going to go. So you probably heard me say this before. I never trade any one sector index or the broad markets in a vacuum. I always look at what affects that, what impacts that. So if you're trading this ETF, and let's say Intel, which reported last night, there's a great example. Intel had a huge move after hours. Most of it was faded today, but that is going to have a big impact on this ETF, but not so much on XSD, which when we look at the holdings here, you can see right here. Yeah, maybe I have a little box tool here. You can see the holdings. The top holding is SunPower Corp, and it's only 4.16, so half of what Intel. And then you go down the line, you look at the top 10 holdings here, and they go down from 4% down to 3%. So here's an ETF which is more diversified and not so top heavy. There's more holdings. You can go to the site again, click that, and it'll give you all the holdings in there. But just understand that and understand why these ETFs will not day to day, why there's price differences in their values and how much each are up or down. And then finally, this is SMH, who a lot of you trade. I had a request to do an update on SMH, and some one reason prompted me to do this video today. And the other one, you can see here, this one's also pretty top heavy as well. There's the holdings. Also has Intel, a big 800-pound grill in the sector. Taiwan Semi right behind it. But there it is. There's your holdings, and as you can see, as you go down the line, each holding has a much smaller impact. So if you had, Cavium, have a huge gap up or down, it's not going to have a big impact on this ETF. However, if Intel has a big day up or down, it will have a significant impact. So understand what you're trading when you trade it, by looking at the individual holdings, because some ETFs are a lot more diversified than others, and there's probably, I assume, that there's a false sense of diversity, if you call it, or safety in numbers in an ETF, because by definition, it's like a mutual fund. They're spreading the money, all your eggs around a lot of baskets. Some ETFs do a lot, and I've seen ETFs that hold, a dozen or less stocks, so they're going to swing wildly. All right, enough on that. Let's look at the charts. Okay, and again, the monthly chart was covered going back for decades, showing you trend line breaks, how effective they were, and really that was the bigger picture. That's the outlook, painting the outlook, in my opinion, where the semis are headed in the coming months to possibly a year or more, which is down. Now, I told you in this video we'd hone in on those levels. I don't trade, I never ever base an entry on a trade off of on any one development on the monthly chart. Even though I built a decent case of a sell signal there, I come down to the daily, the weekly, daily, and even 60-minute charts, especially the daily and 60 minutes, to time my entries and exits, meaning where I buy or short a stock and where I'm going to cover or sell that stock, where my profit targets are. So what we're looking at here on stocks, this is a clean, very simple chart. You can see a well-defined uptrend line, comes off the early 2016 lows, a lot of reactions which validate that trend line. This candle here was an intra-week break. So we closed right about on it roughly. Next week we tested it again. So finally, this red candle right here, the week ending April 6th, that was when we had a confirmed breakdown. You can see we had a red candlestick. It gapped below, stayed below the entire week, and closed down at the bottom of that range. So that was a solid weekly close. That was a breakdown. That's a sell signal. However, like I said in the last video, it's not unusual, fairly common to see once a rising wedge or a trend line breaks down to have a kickback rally, a back test, and that's exactly what's happened. And you can see, technical analysis never fails to amaze me. It doesn't always work perfect on every stock, but to me, between technical and fundamental analysis, this is a much more accurate predictor of stock prices. In fact, in the short term, it's the only predictor. There's not a single active trader in the world that trades off fundamental analysis. You have to use charts. Fundamental analysis, that's what Warren Buffett uses. He's doing investments that he plans to hold for years, if not decades. And that's where fundamentals come in, and they're great. When you can line up your long-term trades, the fundamentals and the technicals, great. But if you want to know where stock's going today, tomorrow, next week, or next month, most likely, you need to use technical analysis. So In this case, we had a breakdown, a back test to the penny, perfect back test. You can see the top of that candle hit there and it reversed. Almost went for another back test, and now we've moved down. So number one, this is pretty bearish. The fact that since that breakdown, we had this level support here. Now we regained it today. We came down. You can see I had a support line, and this is important. This is the levels I told you I'd give you guys the important levels. That's 165.21, give or take. We've gone below it a little bit, so maybe round that down to 165.20 or even 165 if you want to be really safe. Take out these recent lows here, those intraday lows. But so far, you can't write the semis off right now. Longer term, I think you can. But for the very near term, what happened is they have so far, and I'm doing this video, it's 2:45 p.m. Eastern time, so another hour and 15 minutes to go before the close. And you can see this doji type candle means that we went down, we hit that support level almost to the penny today, it looks like, at least from this daily chart reversed, and now prices are trading right back above the support. And again, I'm using that support as it defines some of the recent lows here. I'll put a line there for you. So it defines the lows for the last, this is a weekly chart. I should have clarified. If I said daily, I should have meant weekly. And by the way, guys, so if you're new to the site and I'm jumping all over the place, I always have the time frame for my charts right up here in the upper left-hand corner. Weekly chart also says here weekly chart. Okay, so these are weekly candlesticks. So therefore, 1, 2, 3 weeks we've been holding support, bouncing off that 170, 78 level, even if we've taken it out intra-week. In fact, not only just for the last few weeks, but this is what you want to see with support. You go back longer in time. There's another week we closed right on it, tested it the next week. We had quite a few reactions back here, you can see, from both above and a reaction from below, another close right there on the weekly, and a close from below. So this is a pretty significant level near term. So when this level goes with conviction, particularly on a weekly close, this is why I say you have to, on a weekly chart, all that really matters is a weekly close, because if you short a intra-week break of 178, if you did it here, you did it here, here, any of these instances, you would have been down. We snapped back and regained that level. So this is level number one that has to go. Excuse me. Level number two is 165.21, give or take. That has really contained those intra-week pullbacks. This is where, we've had these stick saves so far. You can see quite a bit of them. So this would be an early sell signal. This would be, in my opinion, the stick a knife in SOXX. It's done, or at least being able to say with a high degree of probability when we see a weekly candlestick close, particularly, especially an impulsive close. What I mean by that is if we close, at 165.19 or something, no, what you want to see is a big red candle. And a close well below that, a big impulsive candle, and that's probably what you'll get. That's the nature of technical analysis. The more well-defined a support level is, the more people are watching it. Therefore, when it breaks, you have more shorts that jump in, and you have more longs that stop out and close their position because support's been broken. And that's why you usually have impulsive breakdowns once support levels go. And again, the more well-defined the support level, the more eyes are on it. Therefore, the more likely you're going to see an impulsive breakdown. And if you don't, that's a criteria for trading. When you have a chart pattern, it really is more important on bullish long side breakouts than shorts. You want to see volume expansion and impulsive move. Volume expansion, I mean 1.5 times or better the 60 to 90 day average volume on that stock. Again, volume is not as important on short side breakdowns, but it does help to confirm it. So there's your levels, and I think if that level goes, I can tell you right now, I'll add minor support. This would be my first target. I think you'd get a hiccup there, minor reaction, meaning around 151.24, and then a move down here to 139.44. Again, this is a weekly chart, and ultimately, and it's quite a ways down, 102.77 give or take, so we can call that 102.80. And from where we're at today, and I have a fairly high degree of confidence we'll get there sometime in 2018. That's a 40% drop, and that's on the index. That's not on the leverage. The leverage ETFs, whether you want to do those or not, you're probably not going to hold it throughout that entire period of time because there will be some kickback rallies. do what you want with trading, but I'm more apt. Like for example, if I'm going to use one of the SOXX in my IRA account to short, I'll probably cover at the support levels where I think we'll have a decent reaction, meaning either a bounce that goes more than just a couple percent or so, or maybe a consolidation period that might last for a week or more, like right here, 139.44. And again, right now I'm telling you what I think will happen if and when we get there, but the charts are dynamic and so is my analysis. So if this plays out, let's say a few weeks, few days, few months from now, SOXX is approaching 139.44. Whether I would cover my position if I'm short or or reverse it, cover it and go long for a bounce will all depend on what I see on the daily and intraday charts, which we're going to get to in a second here. I just can't tell you what the 60-minute chart is going to look like if we even get there. And at this point we can't write it off yet. We could come in for another higher level back test. I mean, anything's possible. We can take out the highs. My analysis can be completely wrong on this. There are some trend indicators, like the PPO is still well above the zero line. That's one thing I'm watching here. That's one form of a trend indicator. I use the 9 EMA, and when it's below the zero line, like it was here, the trend is bearish, and it was bearish here. We're still comfortably above the zero line, and so we have some early sell signals, but we don't have, we can't say definitively that the semis are in a new bear market just yet. I think it's coming. I think the top is probably in, but we have to stay flexible. And the one thing about trading, TA 101, is you either, when you're looking at a stock and you have a support level, you're going to do one of two things. If you're bullish, you look to position long on a pullback to support. And if you're bearish, you wait for a break of support to short. But what you don't do, you don't short a stock that has fallen to support just above it. That's contrary to trading. You might as well just give it a little bit more, another percent or so, and you've broken that support. And then the odds are in your favor that it's going to go down. So again, you don't want to you can try, if you want to try to get ahead of a trade and manage your stops, that's fine. Sometimes I will do that. Sometimes I will take a trade inside of a rising wedge, or even at the top of it, or on support if my confidence is that high that a breakdown will occur. But I'm just trying to tell you, essentially you want to play it safe, wait till that support level goes, maybe a half position there, but full position I think is safe to say on a weekly close below 165.21. All right, so let's go down. I'll get to the other ETFs in a second. We'll just use SOXX here. Daily chart. Story, not the story of my life, but the story of the last 6 to 8 months is one of an unusual amount of stop raids. If I wasn't such a small fish in a big ocean, meaning a small site, I would swear that the market makers, that are out there are following and reading these posts. We had a trade here, and it was profitable. We hit the first target. This is SOXX on the daily chart, so you can see the chart. If you've been with the site for a while, we shorted right around here. We nailed the highs on it. We nailed the entry, and then we nailed the bottom. I made it very clear that I, was not only closing out my position, but I reversed it going long. I was confident we were going to get a bounce. I didn't expect the bounce to go that high. When we got there, and again, this is when the trade was entered up here, I set a stop over 196.40. In hindsight, that should have been at least on a daily close. I mean, it's easy to play the hindsight game, but you can look at what happened. We had a 1 day, actually two, that pierced it there, closed back below it, pierced it there, and again closed below it. So we never had a single close. So yes, if I would have set that stop, which I sometimes do set stops on a daily closing basis because of this, but they ran our stop there. So it depends if you were holding out for the big thing, T2 or T3, and you didn't take profits, yeah, it was a losing trade. And if you covered at T1 because there were quick gains, that's another factor that I have in my trading. And that's why I list multiple targets and I try to communicate my thoughts, is that, I don't list a target if I didn't think there'd be a reaction there. I list price targets at where I think a reaction, meaning a bounce or at least a consolidation, is very likely. So active traders can cover and then reshort. And that's why I don't have a performance spreadsheet on the site, because it's so complex. I mean, what do you count this as, a profitable trade or a losing trade? It all depends on where you're at. But what I do different than any site I've ever seen is every single trade, win or lose, since I've started this site, is archived for public reference. You can go to the completed trade categories. It takes a while to sort through them all, but they're categorized. You can click on the symbol tags, and you can read every single post and then see, the performance that way. Now, all right, moving on back to the what's going to happen and what's already happened. That level now is very important support. You can see the line there. Again, it was our first price target before. If you're new to the site, I set my price targets a little above the actual support level just to help avoid missing a fill if it reverses just shy. But now you can see we've had three reactions. Uh, Usually it's tap, 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 three strikes and you're out. So my guess is the next time we come down to test that line, it will not be a test. We will go through it. That's my guess. That's my expectation. Anything can happen, but like I always say, support is support until and unless broken. So there it is. Now we may gap down below it next week, or we may run back up and back test this channel from below. I don't think so. I think we're going to break it. I think we'll break it soon. Um, Anything else that stands out? Yeah, let me give you a clean board here and show you something else to look at here. There's a potential nice head and shoulders with a double left shoulder. Head and shoulders pattern can have one or two shoulders on either side. Um, that would be your head right here. So left shoulder one, left shoulder two, head right here, right shoulder one. It could be a complex. A complex head and shoulders has two on both sides and then breaks down. So anything's possible. And that's why you just have to wait till the support breaks. But we don't have to have another right shoulder. We don't have to break down here. But if we do, that looks pretty much, and you can see volume confirms. I talk about that a lot. I don't know if you can make out the volume bars. They're right here on this, right here below. But we do have volume expansion on the formation of the right shoulder and volume expansion coming off the head. Those are two criteria in a head and shoulders pattern. So I could talk all day on these charts. There's just so much that stands out to me. Let's look at a couple other things here and we'll move. This is that same chart, SOXX, but I went back to a 2-day period chart, meaning every candlestick's 2 days. It's a limitation with this charting program. If you want to see more than 2 year daily charts, only go back 2 years. So you have to go to a 2-day period chart. So this will show me from the 2016 lows, and I also wanted to show you this. That price channel that I had, again, that's the same channel we are trading off the divergent high. There's also, you can see I put an Andrews pitchfork here, which is a tool, and you can see it really, the outside edges of the pitchfork define the channel. And I also, I've noticed something over the years, when you draw a price channel, and that's maybe why this tool was developed, you can usually put a center point within a price channel, and prices tend to trade that acts as support or resistance. They either get above it. Once they break below it, they tend to go to the bottom of the channel, trade in the bottom half. But you can see either way, we're clearly below trend. We're below the pitchfork. This PPO is down below the zero line on this 2-day period chart. Again, let's go back to the daily and we'll wrap it up here. Well, that's it. Yeah, let's just leave it at that. The targets that I had on that original trade, even though this one was stopped out here, if you're looking, for downside targets, those are the same. I've already adjusted those targets when I put this trade up originally. T1, 150, 160, T3, 139.65. Those are my targets. So to make it very clear, and then we'll move on. This is what I see happening. That's my preferred scenario at this point in time. And I do think that if and when that target's hit, and that's the reason it was a final target, we'll have a substantial reaction. So any semiconductor short ETFs that I'll have there, assuming the markets confirm at the time, most likely I'll be covering at that point at 139.65 on SOXX, or the comparable levels if I happen to use SOXS, or you can even short XOXL if you expect decay. Finally, take it down. This is as far down in time. We'll go to the 60-minute charts. This is the, my swing traders, my favorite swing trading time frame. But you have to keep an eye on the daily charts. Earlier this week, by an oversight, I was so focused on these intraday charts, trading QQQ and the NQE minis lately. I was living in the world of the 60-minute charts, keeping an eye on the dailies, but I missed some big important back tests on the daily time frames. And I've always said this: the longer time frames, take precedence over the shorter time frames. So that back test that we had on, was it Monday or Tuesday, on the daily time frames led to that big correction that we had it was a Monday back test, or on Tuesday morning, I'm trying to remember, led to that big correction. So I had some bullish developments on the 60-minute charts that they started to play out, and they played out for a small bounce and a tradable bounce, but then we reversed hard. So, but now looking at this, what I'm seeing here and what stands out to me is we have some bullish divergence. It's not very steep, almost equal lows on the PPO, no divergence on the RSI, but we do have an oversold, a pretty deeply oversold reading, oversold there. But as I said earlier in the previous video about how overbought in a bull market can become more overbought and often does, or stay overbought for an extended period of time, the same thing in reverse happens in bear markets. Oversold tends to become more oversold and stay oversold. So if, and the evidence isn't there yet, but if this is a new bear market, early stages bear market, what you will expect going forward, both on whether it's a semiconductors, a stock market, any stock, bullish chart patterns and buy signals that worked so well for most of the last 9 years when we were in a upward trending market, meaning you buy pullbacks when the RSI hits 70 or 30, the oversold level, you have bullish divergences, bullish falling wedges, or even continuation patterns. They worked great. So what I'm trying to say is bullish chart patterns have a much higher failure rate during a bear market, just as bearish chart patterns have a much higher failure rate, even if they're textbook looking patterns during a bull market. So I'm pointing out these divergences. Pointing out the overbought reading, and that's another thing that would give me pause right now from shorting the semis going into next week. But should these divergences get confirmed, you can see the PPO right now back testing the 0 line. That's another trend indicator I use. I use the 9 EMA, the white dotted line, when it crosses below the 0 line, which is that dash line like it did here. During that period, the trend is bearish. It was bearish back here was a crossover. It stayed below. Trend was bearish. When it is above 0, the trend is bullish. Pretty simple yet effective trend indicator. Right now, the trend is bearish, and that 0 line not only acts as a buy or sell signal, when that white line crosses the 9 EMA, it also often acts as support or resistance once you break below or above it. So one of two things will happen by next week. We'll either reject off that level, most likely, come down and then take out the support level I talked about, or we break on through it and these divergences play out and there's going to be some more upside in the semis. And if there is, there's a big old gap right there. You can see some levels. I haven't really, be honest with you, I have not adjusted these levels on this chart, so I just did right now. So you can see these would be the first 3 levels. Forget about this one up here. I can actually drag a line and tell you right there. Those are the resistance levels I see overhead. So we'll just have to see, this will have to be continued next week is the bottom line. All right, let's get to I'm not going to go over XSD because I haven't had any requests on that I can recall. If you want me to give you an opinion on it, I will. I'll cover SMH because I did have a couple requests for that one. Okay, guys, only a couple minutes left in this video because a lot of this is the same. These are different companies, different holdings, different ETF companies, but the charts will be nearly identical. Birds of a feather flock together, meaning even though some of these ETFs were more top weighted than others, like I covered in the beginning, the semis move in concert, just like the gold mining stocks. The majority of those on any given day, if GDX is up big, almost every component of GDX is green. Likewise, if GDX is down green, and of course that holds true for the overall longer-term trends as well. So same story. We're starting out on weekly time frame, divergent high, which is I love to see these divergent highs on the weekly time frames. You can draw it out here. Actually, I already had it drawn out on XSD, so even though I said I wouldn't cover that, I'll flip to it. What I'm referring to again, you just look at the indicators down below, PPO, you can see the divergence and the corrections. And again, log scaling, like in the last video, don't underestimate the scope of these corrections. That from the highs to the low right here was a drop of about 37%. There was the next divergent high I can see right there. You can see divergence mark between prices making higher highs and indicators making lower lows down on the bottom, 21% drop. And this drop was considerably larger, probably 30% or more. Now, so what we had here is very large divergence. We started diverging back here from this point. I didn't draw that line, but prices were making higher highs with the indicators making lower highs, and then that divergence really started steepening, dropping off as we made this last final high and we broke in trend. So We had, as I pointed out in the previous video, negative divergence on the weekly trend, or that bearish cross on the PPO, I should say, and some other sell signals. We have negative divergence here on the weekly chart. SXD, if you want, there's my longer term targets on the weekly. Let's get back to SMH. Just wanted to show you all those divergent highs because I already had it marked there. Same story, divergent high here on the weekly. Now, what I have here, this yellow trend line, I'm going to color it up for you real quick. This is what I call sort of the last chance, final straw trend line. This is my preferred trend line. This is the one I have drawn on the others. I have it breaking down. But when trading, if I can draw two trend lines, I'll give the trade or the stock or the ETF the benefit of the doubt, because you don't want to jump the gun. This trend line here, the purple one, doesn't have as many reactions, but because it had one way back here in 2016, didn't have any other reactions until this recent drop here, but there were a few. However, we're also below that one as well. So that was the, final trend line. You can do this, but that's not a valid trend line. In my book, you have to have at least three reactions separate, distinct, apart from each other, well apart, to validate a trend line, because any 2 points can be connected at random. So there's your level on SMH that correlates with that support level on SOXX I gave, 9630-ish, we'll call it. And if and when we break that, which I suspect we do, from where we're at today, the next target down here is about $88, and that's about a 10% or so drop. This is my bear market target on the semis, where I think before all is said and done, whether it takes months or over a year to get there, I think we work our way back to 60-63, which would, from the highs, to kind of give you an idea of how much, what impact that would have on the market as well, because the semis are a big part of tech. That's about a 46% drop, but I do not think we're going to get there quick. I could be wrong. I think the next bear market will be a prolonged, slow, much more slow grind than that quick flush out we had from late 2007 to early 2009. All right, so there's your longer term targets, but again, that's a weekly chart. Here's one board I have drawn on SMH, shows this trend line. What stands out, you can see here, here's something. This chart's a little messy. I didn't have time to clean it up. I have a lot of old annotations, but you can see going almost all the way to the left of the chart, there was a divergent top. You just can't see the indicators, and it was followed by a correction. We had a divergent top, correction, divergent top, corrections. My point is, these are all the divergent highs, and they were mild corrections. Now, okay, Randy, so I see you have a divergent high here. What in this? Yes, and you have a bigger correction. The divergences were bigger. I get that. Typically, the corrections or rallies following a divergent high or divergent low typically are commensurate with the scope of those divergences. Small divergences equals small corrections. Big divergences equal big corrections. But what makes this one different other than the size? I'll show you that. Remember, I've said many times over, this 9 EMA, the white line on the PPO, and you can also, if you don't have a PPO, the MACD will be very similar. It works as a good trend indicator when it's above or below zero, which is this dotted line here. So in each of these cases, we were in a bull trend, a strong bull trend. So these were just corrections. This one was 10%. You still profit off that. You could have 30% if you traded one of the short ETFs, a 3-time leverage. But what made it different is the trend was still bullish. You see that white line, and like I said, remember I said the white line often acts, the zero line, acts as a support level once the trend is above, that 9 EMA is above, and as resistance when it's below. Even though it undercut it by just a hair here, you can see that contained those corrections. So this told you these were mild corrections in a larger, an ongoing uptrend. Now there's a change of character. We broke and stayed under for quite a bit here. We did recover, but then we broke it again. Now we're clearly, for the first time, clearly below there with the indicators pointing down. So that, in my opinion, is what makes this different, and tells me that this breakdown, and you can see here, we not only have a breakdown of this trend line, right, from here to here, but we have it hit support, and again, that same support level on SOXX, not a coincidence. All these levels will line up. It's a key level, about 95.69, and we're back testing that trend line. Again, I have different draws. This trend line doesn't match the one I can draw. I probably have a similar trend line. Let me go through these boards here. There it is. There's one trend line. That's the other primary uptrend line. So the one I just showed you, that was so long, I don't know where that one came from. The one I just showed you here, yeah, right here, this is what I call a minor uptrend line, whereas this is what I call a primary uptrend line because that goes back, you have to go back to a 2-day period chart. You have so many boards. Some of these lines come in from weekly charts. That's it. This is what I was looking at, guys, right here. If this was the primary uptrend line, I had to go all the way back to 2016 to show you it, and that's been broken. Okay, I had no idea how long this video was going. I know I tried to pack in a lot, covered a lot, and unfortunately, because there's different requests for these different ETFs, I had to cover the levels on both. SMH, same story, not by coincidence. Bullish divergence on the 60-minute, oversold. So again, watch those levels on the daily chart. I give you price targets and key levels to watch. And remember, you can, if you're looking for a potential, because I see the potential for a trend, a swing trade that can last weeks, possibly months, or even a trend trade that can go on for months or maybe a year or more. And if that's what you're looking for, if that's the type of trader you are, you can scale into these positions. Scaling in means go, when that first one of the first support levels broken, you have a good sell signal, take a quarter position. The next level goes, add another quarter position or a half position, or then bring it to a full position, at some point. A lot of retail investors and newer traders will average down on a position because they're lowering their cost basis. Most pros will only add to a winning position. Even Jesse Livermore, read, Reminiscence of a Stock Operator, great book. He would add to a winning position. If the position's going your way, it tells you you're right instead of averaging down. So just kind of an FYI, you dig yourself in a hole by averaging down on a losing position, especially if the charts aren't telling you that. Sometimes I'll go into a trade. It all depends on the technicals and say, okay, well, I'm going to start here, and I may add if it drops to this level. But again, that's only if I planned it ahead because the entry point's not too clear. But I don't add to a losing position just for the sake of doubling down or increasing or lowering my cost basis, or in a short raising your cost basis, because that can dig you in a hole. All right, we're gonna wrap it up here. Wow, super long video. Hope you guys enjoyed it, and I'll follow up with any significant developments that I see in the semis. Have a great weekend.